Hello, everybody. This is Jose Blasco. We are about to start. 15 seconds to go. Please, let's have a quick sound check. Type a quick hello on the chat box if you hear me well. That would confirm that all is good to begin the session. So quick hello message on the chat box just to confirm that you hear me well. Thank you very much. We just hit the starting time of the session. So we are now officially live. Very good. I can see Mark, Marcus. How are you guys? Good to see you. Let me turn on my video stream as well so I can say hi to you guys. How are you, everybody? Good to see you. Oh, I can see I have a little bit of background effect, which is not right. Give me a second, guys. Just one sec. It should be better. How are you, everybody? Good to see you. Welcome to the session. Today is June 28, 2020. And we're getting together for sharpening purposes, isn't it? Today is a sharpening day. Sunday, weekend day, the markets are closed, so no need to rush. We can take our time to discuss different matters, different techniques, different subjects, different questions, anything you guys may need from me, in this case, from us as a company. More than happy to go through it. Okay. Again, the only thing left for me to call this session officially introduced is to read the disclaimer. So I will do that. We'll jump into the trading platform and we'll begin the session. So disclaimers: the following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive on using our products. And this is the introduction. So the session is now officially introduced, and I got here a TradeStation ready for anything that we do today. And I'm gonna begin the day, of course, looking at the chat box to see who is with us today, see your questions, see your comments. Marcos, how are you? How are you, Mark? Good to see you as well. Madam Mandiri, good to see you. Osman, how are you? Good to see you. 4th of July FX. Yes, you were right. That's a good way to define it. Yeah, sometimes technology does funny things. Very good. So, my friends, today is a sharpening day. Okay, so normally what we do in these sharpening sessions is to go through concepts many times. What I do is utilize your questions that you guys send in a regular basis, questions that you normally send via email. Normally, I utilize some of those questions because many times some of those key questions are too difficult to answer in an email, in one hand. In the other hand, some of those questions are precious for the answer to be sent to only one person, and because the answer can help actually many of you guys. And many times, I end up utilizing some of those questions as, kind of like the subject of the day, because the questions lead us into specific conversations, okay? This particular week, I have to say that when it comes to questions, I guess it's a matter of, coincidence. Most of the questions that we have been receiving were quite simple to respond in an email. So basically, we clear up everything that was to be answered, and I don't have any specific question to bring to the room today. So I do have a couple of thoughts in the back of my mind of subjects that could be important to discuss. So we keep going on with the sharpening. But before I do that, I wanted to open to you guys in case you have a question and you didn't send an email or you were waiting for today to phrase your question in the chat box. I would like to go ahead and invite you to type those questions or anything it could be that you would like it to be a subject. Maybe it's not a question, but maybe you'd like me to review something. So I'm more than happy to do that. So reading your messages, guys. Sandeep, hello, how are you? Mark, I need sharpening. I am feeling dull. I can see, Mark, today you're coming with a good sense of humor, isn't it? That's nice to see. That's nice to see, my friend. Mandiri, I'm new here. I am following your event too. Very good. No problem. Absolutely. It's no matter where you're at in your trading journey, advanced traders will learn from newer traders, and newer traders also learn from advanced traders. Okay, because sometimes if you are very advanced and you've been trading for a while, you kind of forgot some of the basics. So basic questions are also welcome if that's your case. And if you are new to our session, but you happen to be an experienced trader, certainly go ahead with your advanced questions too. Not a problem. Osman, do we use fundamentals and sentiment analysis when we trade between currency pairs? Okay, good. Very good question to begin the day with, Osman. As always, very thorough questions. I can see that you put a lot of thought into trading, and that's how you master yourself and your methods. Okay, so way to go. Keep doing that. Okay, that's the way to do it. So let's go for it. Okay, and Marcus, I see you have a question too. So I'll be working on Osman's question first, and then I'll go ahead and look at yours. Okay. Cool. Okay, so fundamentals. Okay, fundamentals. So what's more important? Okay, what's more important, the technicals or the fundamentals? Okay, that's the question. Or maybe another way to phrase it is, are technicals important enough to rely exclusively on technicals to do a trade, or same for fundamentals? Are fundamentals strong enough so we can rely on fundamentals exclusively to do a trade, or do we need to do something else, right? So that's kind of like somehow probably the origin of your question, Osman, is coming from that very very initial thought, if you wish, right? So what do you guys think? Okay, because again, I do have an answer for you, but I would like to measure the temperature of the room in this case. Some of you I know have been trading for a while. Some of you I know you are newer to trading. But again, I'd love to know what's your take on fundamentals specifically. Okay, what do you think? When it comes to fundamentals. Okay, and then while everybody is answering the question, Osman, I do have a question for you. When you talk about sentiment analysis, because fundamentals is something that is very standardized in the industry, and therefore we all know what you mean when you say fundamentals. But when you talk about sentiment analysis, now it could be, if you don't mind me to say it this way, it could be a little bit of a fancy term at times, okay? Because different traders may call sentiment a different thing. So if you could be a bit more precise with what you mean by sentiment, that would also allow me to be a bit more precise with my answer when it comes to what I think I know what you mean. But again, I would like to confirm that, okay? So Marcus says, the longer the trade, the more we care about fundamentals, okay? Okay, very good. That's an answer. Only one answer, guys? Really? Come on, don't be shy. Everybody, you guys participate. I can see that we are a bunch connected to the session live. Don't be shy and participate, guys. That way we make the session much richer, isn't it? So fundamentals, and you don't have to have the right answer. Okay, this is a learning session. So even if you didn't know the answer, it's okay. You still have probably an opinion about it. So go ahead and type it in. Okay, don't be shy. So fundamentals. Okay. Well, while I'm waiting for you guys to type your answers, okay. So I'm gonna kind of rewind a little bit, Osman, and talk about what's fundamentals, right? For the ones of you that may not know what fundamentals are, because you are purely a technical trader and you never got into learning anything that is about fundamentals. Okay, so basically fundamentals refers to the health. If we were to trade stocks, it would refer to the health of companies. If we were to trade currencies, Forex, then fundamentals refer to the health of countries and economies. If we were to talk about commodities, it will refer to the health of that particular commodity itself, and the demand and the supply for that commodity. So again, one way to think of fundamentals is that it represents the health, and based on common sense, a product, a market, a currency, whatever it is that you trade, that has a good health should go up, and whatever that has a bad health should go down. Okay, so that's what fundamentals basically. This is a crash course on fundamentals, speed of the light. Okay, so this is what fundamentals basically represent, is the health. Okay, so now based on common sense, it seems pretty logical, to be honest, that you think about, okay, there's a company, this company is just doing amazing. People may not notice at first, but if the company keeps doing amazing and amazing and amazing, people will notice. The company will be paying high dividends as well. That will make people to notice even more. Next thing you know, people will start buying shares. And the moment people start buying shares, the price of the stock will go up. Okay, so good health with a price moving up makes sense. bad health with the price moving down makes sense based on common sense. Same for the currencies. Okay, so if you are dealing with a currency and the health of that economy, that country, that region is doing very, very well, well, people may notice and they want to invest in that region. And to invest in the region, you have to buy the currency. So what's going to happen to the price of the currency is going to go up. Let's say people didn't notice. So what's going to happen? Well, the economy is going to do well anyway. And what are the central banks typically going to do to the currency to control the inflation rates? They're going to start raising interest rates, right? They raise interest rates to slow down the borrowing and control the inflation rates, so inflation doesn't go up too fast. But guess what? The moment the currency starts raising interest rates, that's going to attract foreign investors to buy the currency, right? To buy the currency, because then you buy the currency, you put the money into bonds into that country, and you get paid a higher interest because the interests are being raised to control the inflation, right? So again, again, based on common sense, it makes sense. If the economy is good, if the stock is healthy, again, health equals price going up, bad health equals prices going down. That's, again, as I said a few times already, it's kind of common sense. Okay, so this is kind of like my initial touch on fundamentals. Let me take a look at what else you guys added here. Mark and stocks, Osman in Forex, Osman GDP, interest rate, inflation. Very good. That's what you mean by fundamentals. Got it. You meant that by fundamentals, or you made that by the sentiment? Because GDP, interest rate, and inflation, to me, that's fundamental. Mark, in Forex, the intention of the central bank of the currency is important. If the central bank wants the currency to rise or fall relative to the dollar or the euro. Exactly. Yeah, exactly. And the central banks, they will want to intervene in a particular manner, depending on the health of their economies, right? So again, we are back. It's a very simplistic way to think of fundamentals, but really, if you bring it down to the word health, that's it. It's kind of something that makes a lot of sense, at least the way I think. To me, it does make a lot of sense. I don't know how you guys feel about it, but to me, it does. Okay. Now, so let's say we agree on this concept of fundamentals and health. So give me a second, guys. Okay, yeah, I'm like, what is it that my screen just went black? Okay, got it. Sorry for that. So if we were to agree on this concept of health, so then the next question is, okay, so now that we know what fundamentals are, how do you measure it? How do you measure the health of a country? How do you measure the health of a stock? How do you measure the health of a commodity? How do you measure that? Okay, and that's when fundamental analysis comes into place with a collection of different indicators, such as Osman mentioned a few, the GDP, for example, the gross domestic product, or interest rates that are normally controlled to a certain degree by the central banks, unemployment numbers, the CPI and the PPI, Consumer Price Index, for example. Again, you have all those different particular indicators, right? Now, the problem with fundamentals, okay, and it's a big one, okay, is if you think of two people that are market experts, right? Let's say one is a trader and the other one is a person who works for a newspaper, a media company, doing reports about the markets. Probably that would be a market analyst, okay, and making a living out of producing reports. In this case, working for a media company. Market analyst maybe work for a hedge fund too, is a different story. I'm just talking about that type of market analyst, okay, doing reports and making a living out of doing reports. So probably a market analyst doing that would probably find a lot of help and very good explanations to explain what his or her understanding of the fundamentals are when looking at those particular indicators, right? So you would be looking at, let's say the CPI, and yeah, so people are consuming more, so inflation rate is going up. You would look at, GDP, the exports, the imports are balanced or not balanced, and it's creating an increase or decrease in the GDP. And here's the problem that we could envision if this continues like that, and therefore now the market is falling because this started 9 months ago, and now you can see the market falling. Probably is the GDP issue. So again, they would use all those indicators to give explanations, to explain why things happen the way they happen. Okay. Now, while this is very interesting, and as I said, it's in my mind, it's common sense. Okay, the better the health, the better. The worse, the worse. The problem is that for traders, okay, so now I'll change the group, right? So I talk about two market experts, the traders like us and the market analysts working for a media company. So now I'm back to the traders like us. So if you think about the traders like us, I mean, how does it help you to know that the market is falling because since 9 months ago the GDP values, has started, getting worse, for example, if that was the case? How does it help you? How does it help you? Because you take the trade now. You didn't take the trade 9 months ago. And even if you were to look at the values 9 months ago, and let's say that's when the number started changing, how do you know that because you have a change, just one negative change on any of the indicators, could be unemployment number, could be anything, how do you know the whole thing is going to turn around? Okay, you don't know. Okay, so fundamentals, while they may say a lot about why things happen, the problem is that when it comes to giving you clues on when things are going to start happening, it's a tough one. It's a tough one because normally one indication in any particular direction is not representative of anything. And to understand that, really, you can just watch during the next 4 months if you watch the unemployment number, or if you want to keep it shorter, during the following 4 weeks, every Thursday at 8:30 a.m. New York time, you will have the unemployment claims reported on Thursdays. Okay, the unemployment rate is once a month on the first Friday of the month, so that's why I said 4 months. But if you want to kind of get the same feel at a little bit of a faster pace, just do it every week on Thursday. Okay, they do the updates on the unemployment claims, and you will see what happens. You will see. I'm almost positive it's going to be like that if that was the case. Okay, because again, I watched this for a long time, even though maybe it's not like that in the following 4 weeks. But you'll have cases where the unemployment number is better and the market went up. But same story, you'll have cases where the unemployment number is better, but the market went down. And then you have cases where the unemployment number is worse and the market went up. And then you have cases where the unemployment number is worse and then the market went down again, went down too. So in other words, there is not a direct correlation because of a one change of a one value. And now you know what to do from a timing point of view, when to buy, when to sell, when a move is going to start, when a move is going to end. Just because one fundamental indicator changes value is not enough. You need more. And if you need more, great. It helps you to explain why things happen the way they happen. But if you were to be a trader, you need to be in from the beginning, because if you enter the trade too late, now you're assuming too much risk in exchange for little reward, because the whole thing is already happening when you come in. So that's a problem. Okay, and even let's say you just found this fundamental approach or fundamental analysis, okay, that is very, very precise when it comes to timing the markets, where actually based on certain changes of values or certain ratios that you calculated yourself or some magic formula you invented, when something happens and you have this particular value on your process, that would tell you the whole market is going to turn around and go, and you were to take a trade because of that. And let's assume you have that, which I never seen that, but let's assume you have it. So that would be a good idea for you to enter the trade. But my question to you is, the job of a trader is also to manage the risk, not only to have good entries. Having good entries is certainly critical, but what about your exits? What about when to take profits? And most importantly, what about when to stop yourself out for when you're wrong? So if key unemployment, let me rephrase that. If key fundamental numbers are updated only, let's say, once a month, once a week, and you need multiple figures or a formula that combines numbers, that's going to take a few weeks for you to gather all the information to come up with a conclusion that, what was supposed to happen is not happening, let's get out. Well, then you never know the price at which you're going to go out. Okay, you will never know. If you think about what happened in the S&P a few months back, I mean, in like a week, it was down like close to 20%, just 1 week. So you could be in a situation where you enter a market with great conviction. Next thing you know, it doesn't work, and next thing you know, the moment you have a reason to get out, which is beyond fear or panic. I'm not talking about that. I'm assuming you will be a mechanical trader, even though you are using fundamentals. So the moment you have a reason to get out for a loss, the market may have moved again you 20, 25, 40%. And now what? What are you going to do? So what I'm trying to say is that as traders, we need to be precise. And unfortunately, while fundamentals are important, because in the end, the things that happen in the market happens because of fundamentals. So they are important. The problem is that they don't really help us to trade. they help us to explain why things happen the way they happen, but it's kind of late for traders. Is that making sense? So now, if I was to go back to Marco's question or comment, where he said, the longer the trade, the more we care about fundamentals. So I have to say I agree 100% with you, Marcus, because let's say you identify a certain fundamental condition that suggests that the market should should travel either up or down, and then you have a trading methodology that allows you to take a trade in that direction, and fundamentals are on your side. So what would you do? Okay, well, probably you would, be okay or be open to set targets further away or something like that, and try to ride that move for as long as you can, because you have an underlying force beyond price action, beyond on-field orders, beyond UFOs, beyond everything else. You also have an underlying force, which is what I normally call an indirect force. Okay, and that indirect force, because it's fundamental, normally tends to last for a while. And you may reach a target very far away, and a smart trader could do that and enjoy and profit from that very, very nicely. So it makes sense. Okay, but now if I was to come back to Osman's question, okay, and let me read it exactly the way Osman wrote it. Do we use fundamentals and sentiment analysis when trading between currency pairs? So I would say, with everything I just said, you're kind of guessing that I'm not in love with fundamentals, in the sense that it doesn't add precision enough for our trades. And certainly, if I was to trade very short term currencies or commodities or anything you trade, I would certainly pass on fundamentals completely, because it doesn't give you an edge at all if you trade very, very short term. But if you were to trade more in the longer term, then it would not be wrong to be aware of those fundamentals. Okay, because again, you would have a little bit of an extra underlying force that may help your trade to go further away. Okay, but it really depends on your trading style. So I do have a question for you, Osman. What's your trading style? What is your average duration of a trade? Your trades last 2 hours, the last 2 days, the last 2 weeks. What's the average duration of your trades, if you don't mind? In options, if one is working with I'm reading Mark. In options, if one is working with an individual stock, earnings is important, fundamentals, news about the company is also important. Yes, you're right. But like, for example, earnings is important, Mark, and I'm guessing what you mean by that is the earnings day, you may have a massive gap, stock moving against you, and you need to be aware of that to avoid problems. Just like if you were to trade intraday, and even though I just said that fundamentals are not going to be relevant or that relevant, right? Well, what is relevant though is to know the economical report time of the day, if you wish, right? Because if you're about to take a trade, let's say you are a very short-term trader, your trades last 20 minutes as an average, and you're about to take a trade, and 3 minutes from now, a potential change of interest is going to be reported on the euro, for example, and you didn't know this was about to happen, 3 minutes from now, you may get a huge movement against you in the currency pair you're about to trade. And that would certainly not be the very, very smart time for you to take a trade, right? It would be probably better to let the news be reported and then plan your trade and execute trades based on a little bit more evidence of what the interpretation of the news is, instead of let's hope the news will not stop me out, right? So the timing, just like earnings, okay, the timing of those reports is certainly important. But again, if let's say you want to do an iron condor on a stock and you got options with great level of premiums, really, it's not going to help you too much to know much about the company and what was the earnings report the last quarter, isn't it? So it's more about the timing of when those news are being released, which are fundamental pieces of information, but for active trading would not really matter. Okay, the timing, the time of the day, the day of the month that's going to happen, it's important to avoid risk, but it's not relevant to add probabilities. Okay. Anyway, so back to Osman, 1 to 5 days. Okay, so 1 to 5 days, really, I would say that fundamentals are really not going to be that important to you at all. Okay, not that important to you at all, because again, while they are very important, they play a role in the very long term. Okay, not that short term. Now, the other part of fundamentals I wanted to discuss, and I know there is a little bit more typing on the chat box. Okay, so I will catch up with that in just a sec. But the other part of fundamentals I would like to mention as I'm thinking fundamentals in this conversation is uh, how do you measure fundamentals, right? How do you come up with a process, right? And really, it's very difficult. Okay, it's very difficult because look, let me bring a browser here. Just one sec. Just one sec. 1 second, guys. Just 1 second. So I'm just loading the right web page. Here we go. So I'm looking at Forex Factory here, for example, okay? And I want to go back. It's end of June, really, but I was mentioning earlier the first Friday of each month, we have such a relevant report being reported, which is the unemployment number. So I want to go back to that report just because it's a key report, isn't it? So we can see here, red impact report, unemployment change, US dollar. Well, I just kind of cover it, isn't it? So US dollar right there, okay? And the number was 13.3%. So I want you to take a look at the graph for you to see what happens, right? So now, and by the way, it's a perfect time for us to look at this because, recently there's been, given the COVID-19 situation, there's been a pretty major change in unemployment metrics. And it's very visual in this chart. It was just improving for years. And next thing you know, complete mess, in just 1 month, if you wish, right? So now take a look at this, okay? So when you look at this number, okay, when you look at this number, notice how on May 20, the reported value, which is blue color, was 14.7%. But notice what just happened sometime after, okay? The golden dot represents the corrected, the corrected value, meaning that when on June 5, okay, the number was reported, it was 14.7%. And maybe a couple of weeks later, I don't know when that happened, but that number was corrected to 16%, which is, if you think about it, that's a pretty major difference, right? Before those numbers were, completely changed, the unemployment number was 3.6 and the corrected was 3.5. So basically now we have in May, okay, we have 14.7 and 14.7 was corrected to 16%. So this is like, let's call it, just to round up, this is like 1.5%, where before these huge numbers, we had like around 3%. And if you think about 3% and 1.5, it's like 1.5 is like half. So in other words, the correction of the number that happened in May, okay, it's kind of like half of the unemployment number before the craziness. Okay, and if you look at the last report in June, look at that. It was reported as 13%, and the corrected value is 19.4%. It's completely crazy when you see those differences. So again, if in the very short term you were to trade based on the fundamentals, well, really what you trade is not the fundamentals. What you would be trading is the belief of some people that the reported number will produce an effect in the markets more than the reality of the economy, right? Because the reality of the economy is 19, but no one knew in June when the number was reported. In June, everybody thought it was 13, right? So your belief then relies more on the fact that a figure is reported more than on the fundamental power of what those figures may mean, because those figures are always off. Even in periods of calm, so I'm back to 2014, for example, notice 6.2, then corrected to 6.1. You always have a difference. You can see that with the golden dot. So in other words, fundamentals are very difficult when it comes to their assessment for these trades to help you. and for you to have proper decisions. Okay, now if you were to tell me on the long haul, well, look at the unemployment number force here that took place for so many years. Okay, so if I just keep going for so many years, okay, starting, let's say here in 2010, there's been a great improvement on the unemployment number in the US, and maybe in 2011 you've seen improvement on the unemployment rate, and you're like, you know what, fundamentally speaking, the economies are getting better, so let's plan on buying stocks, for example. Okay, so that could be a good reason. And by the way, if you bought stocks in 11, you could have been in the market for a long and enjoy very substantial profits, because the market just kept going and going since 2009 basically. Without 2011 precisely was a little bit of a flat year, but almost every year was pretty nice. So again, fundamentals matter, but if you were to use them from a very short-term point of view, 1 to 5 days, Osman, it's not that much. So really what you are relying on is not on fundamentals, it's on the fact that there are news traders in the world, and when the figures are reported, they trade the figure. That's not fundamentals, that is news trading, because the figures are not accurate until when they are corrected after the fact, which may take 2 weeks, 1 month, whenever that is. Okay, so keep that in mind. Okay, keep that in mind. And in any case, here that's another complexity, which I just show you the unemployment number. I think that out of common sense, obviously, it represents the quality of the economy. If many people are unemployed, that's not good. So it's again another common sense statement, if you wish. But at the same time, there are many other economic reports which are very, very relevant. So if I was to, again, utilizing Forex Factory here, for example, if I was to go ahead and get into the filter and select only the ones that are high impact, okay, and only the ones that are linked to the US, okay, this is for a whole week, right? So notice how you got unemployment related data, OPEC, that's related to commodities, then CPI, then we got economic projections, fund rates, we have consumer sentiment, we had retail sales, we have specific speeches that could be important. And again, this is only for, well, actually this is for the whole month of June. Okay, so again, which one, and there are some missing numbers there, like such as GDP and things like that, but anyway, I guess you get my point. So which one of those numbers is the one that is going to lead to your fundamental decisions? Or if you're going to take 3 or you're going to take 10, great, but where do you draw the line? What is it, an economy that becomes better? Is it when the unemployment number increases or improves by 1%, or is it when it improves by 1.5? And what about the GDP? How much the GDP needs to improve for you to call it an improvement? And what about the other figure? And what about the other figure? In other words, analyzing fundamentals becomes very complex, and there is a lot of our own opinions put into the decision to do we call that economy, that market, that currency healthy or not. Therefore, should we trade or not? And should we trade to the long side or to the short side? So it's a tough one. Okay, it's a really tough one to analyze. So again, nothing against fundamentals. It's certainly very, very important, but it's difficult for us traders that fundamentals become something actionable in an easy way. It's tough. It's a difficult one. Okay, it's a very difficult one, and also lots of the thinking and the theories about fundamentals that are out there, especially if you read books and things like that, a lot of all those theories are based on lots of historical data starting from decades and decades and decades ago, and nothing is the same. The economies are not the same. The markets are not the same. Markets in the old times were traded by humans. Markets nowadays are traded by computers. The economies in the old times, as long as you got, some cash and you got some transportation and you got, some space for employees to be there, that's it. You have a business. Nowadays, people work from home. You got viruses, currencies. Many countries work with cryptocurrencies now. Everything is totally different. People, the companies, and even people are loaded on debt, and sometimes debt on top of debt, and it's a totally different environment. So again, another common sense statement, how do all those fundamentals theories that were created decades and decades ago, where everything was different, can be applied to nowadays markets? While common sense, I'm back to common sense, does suggest that a good, healthy economy should lead to rising markets, and the opposite is true. Where do we draw the line? What's healthy enough? What's unhealthy? So where do we draw the line? What do we look at, and how do we measure it? It's a tough one. It's a real tough one for traders. So fundamentals is more of a tool to explain why the things that happen after the fact, which is certainly a very interesting approach to understanding the world. But again, for traders, it's not really that useful, because how do you take a trade out of knowing why it happened, but it already happened? So you cannot take that trade. It's too late. So now, having give you all those Miguel, you're funny. So having said all those comments, I do have a good news. Okay, I do have a good news when it comes to fundamentals, because there is one market where you could narrow down fundamentals to one thing in a way that is useful. Okay, and there is a bit, to my understanding and my knowledge, is only one, and is the currency market's spot forex. Okay, is the currency market spot forex. So, for example, if you use a tool such as this, okay, let me find it. Here we go. Okay, if you use a tool like this, okay, and you were to select currencies, and you were to sort these. Okay, I'm going to use the day before Friday, because the weekend there is no swaps. Okay, so if I was to sort these based on how much I get paid, or how much I need to pay to go long, or how much I get paid or how much I get paid to go short, I'm talking about forex swaps. Okay, so you can see, for example, here that if you were to go short US dollars against the Indian rupee, there is a nice payment there, or against the Mexican peso, or the Swiss franc against the ZAR, or you have different situations where you have positive differentials between interest rates between two currencies, and that means that if one country has interest rates greater than another one, while it doesn't mean that country has a healthy economy, and it doesn't mean the other country has an unhealthy economy either, because I still don't know where to draw the line. From a trading application point of view, it's very subjective, right? But if you do have a differential between those two currencies, which is positive or negative, depending if you go long or short, it does tell you that, fundamentally speaking, one currency is stronger than the other one. And why is it that the central banks of that currency decided to raise or lower interest rates, and that's why the swaps are positive or negative? I have no idea. But basically, I am relying on the brain power of the people that work for those countries and governments and central banks. And I'm relying on those brains by simply looking at a swap rate, right? If, for example, I click here, positive long rates, and I see US dollar Swiss franc. So if I go long the US dollar Swiss franc, I'm going to get paid $1.48 per lot per day. That means that the interest rates that I get paid on the US dollar are more than the interest rates I have to pay with the Swiss franc. So what does that mean? The interest rates in Switzerland are lower than in the US. And given the fact that we're in a global economy where most of the actions from central banks may not happen at the same time, but the actions are similar in order to control their monetary policies. So that means that, fundamentally speaking, probably the US is in a better position compared to Switzerland. Or at least this is how it's being seen by the brain power of those those economists and advisors that work for the central banks, who know more than economy than me, right? Because I'm just a trader. Is that making sense? So, if you look at positive or negative swaps, and you were to call this your speed of the light fundamental analysis, I would say it makes sense, right? Because those numbers represent not that a country is strong or weak or whatever, but the differential between the two currencies, okay? It's either positive or negative, which gives you a measurement of relative strength from a fundamental point of view between those two countries or those two currencies. and therefore now you get into a trade to trade in that direction, assuming that you have a chart setup that allows you to. And now not only you benefit from swaps while you're in the trade, which you do that for the long term, right? Because if not, it doesn't make sense. But not only you benefit from the swaps, on top of that, you benefit from a fundamental force in your favor, given the fact that the positive swap implies that one currency is stronger than the other one, fundamentally speaking, at least based on the beliefs or the understanding of the economy in those countries from the brains that are advising central banks. Okay, and I rather rely on them for that the information I got available, because they have access to that I don't have. As a trader, I can get into fxtrade.com, right? And I get in here and I can get into the economic calendar, and I got amazing information. So if I want to know anything, I have so many figures, right? But all of this is whatever is public, whatever is reported. This is reported after the fact. The number is published and then it shows on the website. Great, thank you very much. And by the way, that website is amazing for that purpose. But how do I use that for my trading? I'm back to the same question as always. How do I use that in my trading? So again, it's a tough one to add fundamentals in your trading for timing purposes. But in Forex, maybe a little bit of an exception to the rule when you look at positive swaps, either to go long or to go short. You can do the same going short. So, here, for example, maybe you can go short the euro US dollar. Okay. And if you go short the euro US dollar, you get paid. Okay. What does that mean? It means that the interest rates in euro are less than the interest rates in the US. So that's nice. That's a good one to know. And it may make a difference. Okay. Especially if you keep your trades for a long time. Okay. I need to go back up the chat box, okay? But I'm reading the last question with Mark. Aren't these indicators for relative strength? Relative strength have to do with technicals. So the classical way to measure relative strength is to get the average price of a currency and compare to the average price of another currency and look at, what's the difference between two, and do that with a collection of currencies. And then, kind of give them a rating. And then you may realize, what, the Swiss franc is very strong against everybody, or the euro is very weak against everybody, or maybe the pound is strong against the US and the euro, but is weak against others. And you get that type of indication, but that's technical because it's based on price movement. This is fundamental, okay? You have a perception from the central banks that sets the euro interest rate higher than the US at this moment in time. That's how you get a positive swap when shorting. And the question is, why is it that the central bank in Europe decides to have a higher interest rate compared to in the US? Why is it? Okay, and the reason has to be fundamental based on their understanding. Okay, they may try to achieve a certain goal by doing that. They may achieve it or they may not. That's fundamentals. But that's where they're at, and that's where their thinking is. And their thinking is like that because they have access to data that we traders don't have. And even if I was to have access to that data, I would not be able to interpret that data because, at least in my case, I am not an economist. I'm a trader. Okay, and before that, I was an engineer. I understand economy to a certain degree, of course, but I'm not an economist capable of working for a central bank. Okay, that would not be. I would not be doing a good job there at all. Okay, so in that sense, by looking at the swap, automatically I am basically being reported what those guys think in a way that matters to me as a trader. So if I short the euro, in this case, I am benefiting from the fundamentals and benefiting from payments of interest rates in the form of swaps. Okay, so that's nice to know. And if you're going to be in a long trade, in a long duration trade, so not only you have fundamentals on your side, okay, based on those brains, but on top of that, you get swap payments. So that's nice. Okay, but again, if you were to enter the trade just because you have positive swaps, then the timing may be wrong, because what's the problem? Maybe next time the European Central Bank speaks and talk about interest rates, they're going to change the rates, and then the swap goes away, becomes negative from positive. Okay, so it's not exactly relative strength, Mark. Okay, so anyway, back to earlier on the chat box so I don't miss any questions. So first of all, Osman, how are you with my answer? Is that making sense to you? Is it not making sense to you? Hopefully I did get your question right, and this is a complete answer to your question. Sometimes I love trading so much. Sometimes I'm sure you have seen it before. I go in a tangent, okay, and I may get into a conversation that I realize like 25 minutes later that I went too far in a direction. I should be in a different direction. Okay, so this could happen, but it's okay. Um, Good, Marcus. I see you have a question there. So let me finish with Osman, and then we look at yours. Yeah, yeah. Osman got it. All good. Wonderful. Miguel. Uh, yeah. I guess it's not a matter of how many monitors, Miguel. It's more a matter maybe of how much coffee, something like that. Sorry if I'm driving you crazy, guys. So anyway, Marcus, I Jose, my question is in regards to executing or assigning options. I'm guessing you mean exercising or assigning options. How can I execute an option, and how does it work when someone executes an option I sold? Okay, very good. So again, the term is exercise, not execute. Okay, you execute an order, but you exercise an option. Okay, you don't execute an option. That's just a matter of terminology. Okay, and not a big deal at all. But since I see it written, if you don't mind, I'll just give you the right term. Okay, exactly, exercising. Very good. So let's talk about both ends. Okay, so let's talk about both ends. So how do we, let's say you are long an option. Okay, so one day, let me open an options chain. I'll take a sip of water, by the way. So loading Option Station Pro. Here we go. So Nike, whatever. So let's say you have purchased, 54-day options on Nike. You bought the 95 call. Okay. So I'm just going to assume absolutely does not need to be like that at all. But let's pretend that you bought the August 95 call on Nike. Okay. So you bought that call, right? So what does it mean that you bought? It means that you paid. So if you paid, what happens automatically? Well, what happens automatically is that you have the right. You have the right to exercise. Okay. So you can exercise your right because you paid to own that option, and because you paid, you have the right, and therefore you could choose to exercise. So one portion of your question was, okay, so if I want to exercise, how do I do it? Okay, I want to add one more part to your question, which is why would you ever exercise? That's another part of the question. I don't know if you thought about it, but I would like to bring a couple of thoughts there. Okay, but anyway, how do you exercise? Well, with most brokers will take an exercise instruction on the phone. The only platform I've seen that allows to do it on the platform itself is Interactive Brokers. That's the only platform I've seen. I'm not saying it does not exist in other platforms, or maybe it does exist in other platforms and I didn't see the option, or maybe I just don't know how to do it with other platforms. I'm not sure. But the only platform where I've seen it, like a button, is Interactive Brokers. All other platforms, you will need to pick up the phone, get in touch with a trader on the desk, and basically tell them, hey, I own a 95 call on Nike and I decided I want to exercise. If you exercise, of course, next thing you know, now you have shares. The option disappears, the premium you paid disappears, and now you have shares at the price of the strike, which in this case is $95 per share. Okay, each call represents 100 shares, so you would be long 100 shares of Nike at $95 per share, no matter the price of the stock, and no matter how much you pay for the option. And again, the option is gone. The money you paid to buy the option is gone, but now you have shares bought at 95. Okay, that's what the exercise does, and this is how you do it. You just call, okay, call or click the button in IB or potentially other platforms too, which I don't know about. The portion I wanted to add to your question is, why would you ever exercise? Okay, why would you ever exercise? Because again, if you bought this call and you paid 490, okay, true it is that the current price of the stock is 93.6. Okay, so the price of the stock is actually lower than the price of the option. So why would you want the stock at 95 when the price of the stock is 93.6? You can go ahead and buy the stock at 93.6, which is cheaper than 95, correct? So why would you want the stock at 95? Plus, on top of that, if you bought the 95 option and you paid 480, you're going to lose 480 times 100. That is $480 are lost. And the stock is purchased for you at 95 instead of 93. So if you were to call a broker and say, I want to exercise my 95 call on Nike now, probably they would ask you 3-5 times, are you sure? Are you sure? Because they would be thinking, this guy is crazy, right? He's going to lose money and put themselves in a disadvantageous position. Now, still, there are people that do it. Why? Because maybe tomorrow Nike pays dividends. And if you don't own shares, you don't get the dividends. So, some people may do it just so they get the dividends. But again, how much is the dividends, right? So if the dividends is, 1.2% a year, maybe it's less than 480, which is what you're about to lose by giving up the call, by exercising, okay? So again, it almost never makes sense to exercise a call. It only makes sense for when a trader wants to own the shares. And this, in my mind, there is only one reason, which is dividends, okay? You may say, wait a minute, now I am a shareholder, I have the right to vote. Great. That's another benefit. At least in my mind, I would never own a stock because I want to have the right to vote. And that's, in my mind, it's a bit too romantic. I don't know, maybe you love Apple, you're very proud of your iPhone, and you want to have the right to vote and be able to call yourself a shareholder, okay? I just pick Apple as an example. It's a great company for sure. But again, hopefully you get my humor. To me, it doesn't make sense, okay? But some people does, okay? Some people does. And that's how you do it. You would just go ahead and pick up the phone and call, and now you get exercised, okay? So that's one part of your question. The other part is about the assignment, okay? So let me see. I see as well, Vicentius, you have a question. So I'm coming to you in just a minute. So Marcus, again, my question is regard to how can I execute an option and how does it work when someone executes an option? So, okay, got it, perfect. So the first part of the question, I guess, is already answered. The second part of the question, which is how does it work? Well, to be honest, is a little bit of a mystery. Okay, all of this is supposed to be regulated, and for sure, I'm sure brokers are audited and everything else. Now, I never worked for a broker. I never worked in their department where they manage exercise and assignments, so I never seen it firsthand. And I have my doubts that while they are audited and there is regulation, I have my doubts that there is not certain level of convenience throughout the process. Okay, let me explain what I mean by that. So let's say, okay, that someone, not you, but someone bought the 95 call and you sold them that call. Okay, so you sold the 95 call to someone who bought the 95 call from you. So you got paid premium, okay? And because you got paid premium, if the buyer of the call chooses to exercise, because they have the right, so then you will be assigned, okay? And you will need to fulfill your obligation, which in the case of a call is to sell shares, okay? So you will need to deliver shares. Shares will be called away from you, from the buyer of the call, by exercising the right. Okay, so calls are gone from you and they go into the hands of that person. Okay, that's the risk of assignment. Okay, so you may be assigned. Okay, now. Is it going to be exactly like that? Is it like someone bought a call, you sold the call to that guy, and if the guy exercises, the assignment is assigned to you? Well, no, it's not exactly like that. So think about a broker where they may have a long list. They may for sure they manage a database, and in that database, what I'm trying to represent here with all those lines is different traits of people that any time in the past until today have sold the 95 call. So there are many people in the brokerage house that are short the 95 call, and now the guy who bought the 95 call calls the broker and says, hey, I want to exercise. So what's the broker going to do? Pick you because you are the one who sold the call to this guy, or pick any of the customers that are short 95, the 95 call? Well, the regulation, the theory suggests that it's a random process where the broker randomly would pick one, and that person is the person being assigned, and that person would need to deliver the shares. Okay, but again, I have not seen it. Okay, and you guys, I'm just gonna make a statement here. You guys think anything you decide to think about my statement, feel free to type on the chat box if you think I'm right or not. Again, what I'm about to explain, I have not seen it, but I've seen other things brokers do, and I would be pretty positive that this random process by which they're going to pick one of their guys, which are short 95 call, and assign that guy and leave the other guys alone. So the guy they will pick probably is going to be a person who is likely going to create less trouble for the broker. So let's say that person doesn't own the shares. So this guy here, let's say that guy here doesn't own shares, so cannot deliver shares. And on top of that, that person doesn't have enough money in the account to get short shares. Because if you sell a call naked, meaning that you don't have shares, and you are assigned, then you are basically short shares because you need to deliver shares you don't have, so that makes you short. But what if that guy not only didn't have the shares, what if that guy doesn't have the funds to get short? Because the margin required to be short a call is less than what you need to be short the shares. So what if that's the case? Well, if that's the case, the broker will need to assign this guy and then create a margin call against this guy, contact the guy and try to get money. And basically that's going to be a complicated process for the broker. So I have not seen this, but I'm pretty positive that when the brokers run that random process, somehow within the random process, they should have a way to look at their customers and look at who is the most suitable trader to be assigned without creating any problem to the broker. And probably that's the one that is being picked to deliver shares to the call owner, which is claiming the right of exercise. And that's how it is. Okay, that's how it is. Even though the last point I made about the smart action from brokers, I cannot prove that. Okay, but again, maybe I should use the term common sense. Maybe it's common sense. Some investors just want a position in the company like Buffett. Well, yeah, but Buffett owns many shares to a point where he has control over companies, right? And by the way, when he buys shares, he doesn't buy share in the open market, right? He does that through market makers and very special deals with brokers where, given the quantity they buy, they will move price, isn't it? So they get specific deals for people that own shares to deliver shares at a specific set price, through a deal instead of doing this trade electronically in the market. So it's a little bit of a different story, Mark. Yeah. Very good. So Marcus, did that answer your question? How you exercise and what happens if you get assigned? Yeah, the Buffett wannabes. Got it. Yeah, wonderful. Very nice, Marcus. Very nice. Good question, my friend. I'm excited to see that you are getting deeper and deeper into options. and putting thought into it. That's very nice. Vincentius, hi Jose, in Option Station Pro, is there any difference between placing an order by market orders with activation rule applied, with buy limit orders with the same activation rule applied? Well, the difference is massive. Okay, not only there is a difference, the difference is absolutely massive. Okay, now let me make sure I understood what you mean. So let me go ahead and do this. Okay, so let's pretend. Let me pick another stock, which is not Nike, because I got some analysis there on Nike. So I want to use something fresh. So for example, Johnson & Johnson. So I'll load Johnson & Johnson. I think there is nothing in the analysis tab. Yes, isn't it? Very good. So let's begin here, and let's pretend, just same story. Let's pretend that your trade implies that you're gonna use using August expiration. You're gonna buy the 135 call. Okay. So let's say you're gonna do that. So I am adding this to the analysis tab. I just added buy one of Johnson & Johnson August expiration 135 call. Okay. Let's say this is your trade, and to make sure I understood your question is, okay, let's say I want to trade that one. Okay. And let's say you have an activation rule that says that if, so let's do this. I'm just gonna make up a few values here. Here we go. So let's say you have a trade plan that says that if Johnson & Johnson gets to 134, that's your entry. If Johnson & Johnson gets to 132, that's your stop loss. If Johnson & Johnson, okay, I just hit the wrong key, guys. So 134, that's your entry. Okay. 132, that's your stop loss. And if after getting filled, Johnson & Johnson rallies and reaches 145, so that's your target, right? So in other words, 134 would be your activation rule to enter, and both 145 and 132, okay, would be your activation rule to exit. Okay, that would be 145 and 142. Okay, so if that's okay, I just obviously made up those values, but they're going to be very useful for the example. Okay, so with this trade plan in mind, you want to buy the 135 call, and your question is, when I do this trade, is it different for me to do trade? Okay, by market order with an activation rule that says if Johnson & Johnson, I'm doing the entry, okay? If Johnson & Johnson goes less than or equal to 134, buy. Okay, so let me place order so you see it. Okay, so your question is it different to do market order with an activation rule, Johnson & Johnson less than 134? Is that different than doing limit order with the same activation rule? Right? So limit order with the same activation rule. You're asking me if that's different or not. Correct? Are you with me on that? Is that your question, Vincentius? I'd like you to confirm that to make sure I interpreted you well. Sandeep, I would say I have 100 shares of a company and the stock is going sideways. Should I keep selling calls above UFO or selling puts below UFO? Well, if you already have shares, you should be thinking of exiting, right? So you would be selling calls. If you were to sell puts and the price of the stock falls, you're going to be put more shares to you. That's why it's called a put. Okay, you would be assigned and be put shares. So instead of 100, now you would have 200. So if you want more shares, sell puts. If you don't want more shares, sell calls above the UFO, and that way, if you get called away, you will be called away at a high price, and you will be happy to collect the profit you made on the call as well as the profit on the stock. Okay, that's how you would do it. Very good. And I see, Vincentius, you confirm that this is your question. Okay, so there is a massive difference. Okay, massive difference, because let's begin with market. So if you do market, notice, and let me go back to hiding the order. Notice that the bid price of this call is 7.3. The ask price of this call is 7.95. Okay, and if you do the difference, that's 65 cents, right? 65 cents is the difference. 65 cents divided by 7.95. This is 8.1%. So in other words, the whole spread of that call implies that if you use a market order, for you to get in and for you to get out, you lose 8% of the value of the call. Again, if you reach your target price, which is 1,250, your target price, which is 145, the call is likely going to become 1,250. So from 550 to 1,250, you're going to make $700. So you may be like, you know what? I'm going to make $700 on this trade if I'm right. I'm rounding numbers, okay? I'm going to make around $700 if I'm right. The spread, and therefore the pain I get by using market orders is $65, right? 65 cents times 100 is $65. So you know what? I'm going to make $700 and I'm going to lose 65. I'm okay with that, because in the end, 700 minus 65 is still 635. So I'm going to be in a nice trade here. Okay. So let's say that you're thinking. So, well, if that's your thinking, I would say it's not crazy for you to use a market order. But to me, it is crazy, because missing $65 out of a $700 profit, that is, again, all of this is rounded value. So that shows us 9%, earlier 8, now 9%. So you get my point. Is, you may give up like 10% of the profit that you would have made. So why would you gift that to someone, right? Why would you just give that money to someone else? It's not efficient. Okay. I mean, if you do it for yourself and you do it at home, I guess, when no one is watching, so I guess it's easier to get more relaxed. But instead, this is about being professional, right? So let's pretend you are working for a fund manager, and you did that with hundreds of contracts, right? And for every contract you give up 65, and you did that with 100 contracts, so you just give up that amount of money. So you may get fired, okay, if you were to work for a hedge fund. Okay, so not happy to use a market order to enter an options trade at all, because you give up on way too much premium, up to 65 cents in this particular example. Okay, so a limit order would be much better, because with a limit order, you can tell the market how much you want to pay for the trade. And while you may not get filled, okay, because that's the nature of limit orders, okay, you may not get filled. The reality is that if you do get filled, and if you use options that are liquid enough, normally you will get filled. And the beauty is that now you get filled at a price you want or better. So that's nice. That's good. Okay. But the challenge is, so what the limit price will be? Because right now, the limit price of the option, okay, if we were to look at the midpoint, would be 762. So you could place an order now and pay $762 to buy that call. But we are not entering now, right? The current price is 137. So see, if this is 134 and this is 145, so 137 is somewhere here. So you will want to wait for the stock to drop to 134 and then buy the call. And what happens to the calls when the price of the stock goes down? They go down. Actually, the simulator is telling us the expected value. They expect the value of the call to be around 554. They expect that. But this is just an estimation. And so what could you do? Well, option number one is you come here and it's like, you know what? That's it. This is what I'm going to do. I'm not going to use an activation rule. So activation rule is unchecked. And I'm going to use a limit price, which is 554. Because, and by the way, you cannot 54. It has to be 55 in this case. Because some options trade in multiples of 0.05. So In this case, if I try to type 4, it does not allow me to. So it has to be 0 or 5. So 555 is what you would pay. And if you place an order, you would now be relying on the simulation that assumes that around 555 is when the stock is going to be reaching around 134. And maybe you place a limit order without the activation rule, relying on that estimation. Okay, that's another way to do it. But what's the problem? The problem is that options prices, especially the extrinsic value portion of the options prices, is impacted by variables other than the price of the stock only, such as volatility, time to expiration, interest rates. There are multiple things that impact the price of options. So you may have the price of the stock come to 134, and because it was falling from 137 to 134, as the market is falling, everybody's going to be scared, and options prices start expanding, and next thing you know, this when you reach 134, the price of the option actually is not 554, is 600. Okay, and you were sitting there with an order to buy at 555. So guess what? You never got filled, and the stock turned in the opposite direction all the way to your target, and you missed the fill, even though you hit 134, because your order was only looking at the limit price. You missed the fill. So good news though. Now you will not give up anything on the spread. You will have a very precise entry price. But bad news, you just missed the fill, because as the market was going down, options gained value, and therefore this estimation basically didn't work the way it was supposed to, right? So how can we do it better, right? Well, here is how we can do it better. Okay, so when you look at the call that you have here, you can right click. Not here, because this is the order placement. Let me close that one. Here. So when you have this call here, you can right click, okay? And you have an option to copy the symbol. Okay, copy the symbol. So I want to copy the symbol. Options, and I'm sure you know these, have symbols. Like stocks have symbols, like futures or Forex got symbols. Options too. They are very long. So instead of typing where you have a high probability of making a mistake, notice how I just right click to copy symbol. Because now that I right click and copy symbol, I can come here to the order bar with options. Okay, I can come here to the order bar with options. Okay, and I can go ahead. Oh, sorry for that. And I can go ahead and paste the symbol. So right click, paste, and now I have the symbol here. Okay, I have the symbol here. So what can I do with this? Well, I can tell, let me pin the order bar so it doesn't go away. Okay, so I got my option symbol right there. Okay, and now I can work on the limit price. But what's the beauty? Notice this button here, auto. So I can click on auto and tell TradeStation that I don't want to type a price such as 5.55. I want to leave it empty, and instead click on auto, okay, and select, for example, split. If I select split, notice the definition of split, it takes the bid price and the ask price divided by 2. So that's going to be the midpoint, okay? That's going to be the midpoint of the options price, right? So I can select split, and now that I select the split, I can go ahead and activate and use an activation rule on the right, okay? Use an activation rule. So I can tell TradeStation, hey, if the price of Johnson & Johnson was to drop to 134 or below, okay, let me zoom in so you see this. If the price of Johnson & Johnson was to drop below 134, equal or below 134, then activate the order. If not, the order is dormant. If this condition is met, is an activation rule, activate the order. Wake up that order, right? And when that order is sent to the market, that order is going to do what? It's going to take whatever price is available now and split it. That's what that order is going to do with a limit order. So take a look what happens if I click buy to open. Oh, okay, yeah, I cannot do it now. I cannot do it now because the market is closed. Okay, but basically, what will happen is that you would have a confirmation window that tells you, are you sure you want to buy the 135 call on Johnson and Johnson expiry August with an activation rule where Johnson and Johnson is less than or equal to 134, and with a limit order where the price will be automatically set by splitting the bid and the ask price. And if you were to agree on all of that, you click buy to open, and basically you will be saving a lot on of cost compared to doing the same with a market order. Okay, and lowering the cost not only is always a good thing to do, you got a more precise price, but also you have less risk, because the most you can lose when you buy an option is what you pay for it. So if you can save, let's say, $40, then you have $40 less of risk per contract. Okay. So Vincentius, this is your answer. Hopefully this made sense. Yeah, and it seems that Mark left or is leaving, and Osman as well. You guys take care, my friends. It was good to have you. Actually, we are reaching the end of the session too, and I see no more questions. So I believe that it's probably going to be the time to say goodbye for everybody. But just to make sure everybody had the chance to ask their questions, is there anything else out there? Any other question? And Vincentius, I can see your confirmation that you got this, and thank you very much. Very good. So I guess it's all fine, all good. Wonderful, everybody. As always, it's always a super pleasure to spend a little bit of time with you guys, especially over the weekend. It's no rush. Markets are closed. We can take our time, talk about things that are relevant. It's a special time for me always when we meet together on the sharpening sessions, because your questions give me a way to measure the hard work that you put in place in your practice. And I love to see that. Okay, where when we do trading sessions, it's just like, okay, let's find the trades, right? So I love this little time in the weekends. So thank you for joining, guys, and see you soon, everybody. Yeah, I see no more questions. So that's it. The session is now concluded. You guys take care. See you next one. Bye bye, everybody. Take care.